between 2017 and 2011 and 2017, sorry. Then the purpose of it is to enhance regional connectivity, promote tourism and trade. It was, though was not included here, but it was constructed under a land of 329.7 hectares, and it has got the capacity of 125,000 passengers per year. So the total cost of construction was 3.013 billion. So it was constructed in two phases. Phase one, the cost was 1.7 billion. Then phase two, 0.9 billion. Then the land acquisition was at 0.413 billion. So all these brings to the total cost of 3.13 billion. So we assumed an interest rate of 10.75. The reason for this is that was the interest rate for the treasury bonds in the year 2017, because it is the most uh, accurate interest rate at that particular time. So we want to calculate the future value of this 3.013 billion. So if this cash was not used for this particular project and invested in the treasury bonds at 10.75%, for the next 10 years, the future value of that particular cash was to be at 8.36 billion. Then for 15 years, the future value of 3.013 at 10.75 interest rates is to be at 13.94 billion. Then for 20 years, the future value of the same cash, if invested on treasury bills at 10.75, is to be at 23.22 billion. So this reflects, remember, when you're the value of a dollar today is not equivalent to the value of the dollar tomorrow, factoring interest rate, because that particular amount is, if invested in banks, then with the interest rate, the value increases. So this money, if it was invested at this in 10.75 interest rate, it could give these particular amounts over this period of time, 10, 15, and 20 years. So this reflects the true economic cost of the airport investment. Next slide. So the expected, next. The expected number of planes to break even are these. So we have seen the net present value of that cash during for different time periods. So we want to see the expected number of planes to break even. To break even basically means a point at which an investment profits or returns equal the cost. So a point whereby the net present value is equals to zero. So for this analysis, we need to understand how do airports make money, or how do they earn income. So for the first two slides, we have seen the cost of the airport. Then for this one, we want to see how now they earn, the airports do earn income, the demand side. So, and we want to see the cash flow, how cash comes into the airport. So they airports earn cash through day landing prices and also night landing prices. So there are lightest planes and even the heaviest planes. So for this analysis, we took the landing prices for the heaviest planes, both day landing and night landing, for the same period of 10 years, 15 years, and 20 years. So the chart or the table on the left basically shows the day landing prices for heaviest planes, day landing number of planes, sorry. So for the airport to break even, for them to have a net present value of zero, the expected planes per year should be 3,699 for 10-year period. Then monthly, they should be expecting 308 planes. Weekly, 77 planes, then daily 10 planes. So the same applies to 15-year period and 20-year period. Then night landing prices for the heaviest planes. For 10 years period, they are supposed to expect 3,082 planes annually, 257 planes monthly, then 64 planes weekly, then 9 planes daily. So the same also applies to 15 years, 20 and also 20 years. The next slide. Now the expected revenue for them also to break even. So we have seen the number of planes that they should be expecting annually for 10 years, 15 and 20. So now let us see the expected revenue for them to have a net present value of 0. So for 10 years period, they need to expect a revenue of 836.4 million annually, then 69.7 million monthly, and 17.4 million weekly, then 2.5 million daily. Then for 15 years, if we take a 15 years period, they are supposed to expect a revenue of 929.1 million annually and 77.4 million monthly, then 19.4 million weekly. Then for daily, 2.8 million. The same applies to 20 years period time. The next slide. So now we want to see what now the actual airport revenue. Those are the ones we have seen earlier is the expectations. But now what does the airport really receive? What is the actual revenue that the airport really receive on an annual and even weekly basis? So using the landing cost, day landing cost of 226,105. This is the landing cost for the heaviest plane in according to the Kenya Civil Aviation Authority. So during the day, the landing cost of plane is at 226,105. Then the cost or the price for night landing is at Kenya shillings 271. So we are able to see that at least the night landing prices is somehow higher than the day landing prices. So the reality check here. So we want to understand how many planes. According to the latest data, we found out that Isiolo only receives 4 planes per week. So if you multiply that, you come to realize that there are only 208 planes annually. So using the landing costs, day prices, they are only receiving 47 million per annum as revenue. Then night landing prices, they are only receiving 57 million per annum. So we are able to see a shortfall of over 450 million. So if you compare this to the expected revenue, they have a shortfall of about 450 million per annum. Then this is represented graphically on the right-hand side. We're able to see that the expected returns versus the actual as estimate of day and landing prices or costs. So in 10-year period, the expected is 506.3 million, but in reality, the actual, according to the 4 planes or the 200 planes annually, they are receiving only 47 million for day landing prices and 56 million, assuming that maybe if all the planes were landing during the day, they are only receiving 47. But if the planes were landing during the night, they are only receiving 56 million. So we're able to notice that the expectation or the expected returns is so much higher than the actual money they are receiving. So for them to break even, it is either they increase the number of planes to the number that we saw earlier, which is about by about 2,879, or increase the cost or the price of landing both day and night. Let's assume maybe for day, they should increase the cost of landing to about 4,21,153. But if the cost goes that much higher, that implies that it will be expensive for even traders to transport using air their products. It will be expensive, and people can opt to other options like transporting through road and even seas. So this implies that we are able to conclude from our data here that basically, in as much as Isiolo Airport is having a number of planes that are there four per week, but it is still not reaching up to the expected return. So it is basically a white elephant, because we're able to notice that the net present value is negative when you subtract the expected the actual amount they receive from the expected return. So it is a negative value. So Isiolo Airport is basically a white elephant project.
We'll speak next about the standard gauge railway. And so let's start with the history and some facts about the railway itself. So let's go to the overview of the SGR before we can calculate the net present value and make a determination about how its costs stack up against the investment. I mean, how the investment costs stack up against the revenues that it's received. Now, so the standard gauge railway plan, we all know about it, actually has 4 phases. So the first phase, which was the first one to be constructed, was from Mombasa to Nairobi, 472 kilometers of track. The tonnage capacity in terms of how much cargo it could carry was 22 million tons per annum, with a cost equivalent of $3.8 billion. It was completed in 2017, therefore giving it a net present value in 2017 of $3.8 billion. Soon after, the phase 2 was commenced, which covered Nairobi to Naivasha. It's about 121 kilometers. The cost for that portion of the railway line was $1.5 billion. It was completed in 2019. And because it was completed in 2019, we cannot stack up the $1.5 billion to the 3.8 in 2017, because 2017 becomes our base year for returns on the standard gauge railway. So it comes down, we discount it by that year's equivalent of treasury bonds, not bills, which were upwards of about 11, but this comes down to about 10. So we use a figure of 10 for that purpose. So the total for the first 2 phases that have been completed, phase 1 and phase 2, equivalent to 592 kilometers of rail track, comes to $5.1 billion based on a baseline of 2017 numbers. And because it's already working, that's the basis upon which we use to make the assessment. We know that there's a phase 3 that's supposed to cover from Naivasha to Kisumu, 270 kilometers of track, and a phase 3B, which is supposed to cover from Kisumu all the way to the Malaba, which is the border with Uganda. Now, these are still pending, and the cost for them have not been entirely declared, but the estimates come to about 3.7 billion for the Naivasha to Kisumu. And then, of course, there's the estimate that it will be about between $2 to $3 billion between Kisumu to Malaba. So we leave those as pending, and they will not be the subject of, they will not constitute the analysis that we make about the standard gauge railway itself. Regardless of that, because the railway line is working, and as we'll see, most of its revenues come from the cargo, it is still possible to assess this net present value. Now, what is also known about this agreement between Kenya and various banks from the Chinese government, state banks from the Chinese government, it was that one, it's a railway line whose specific, or rather the terms for these first 2 phases was 15 years. Some people have said 17, but I suspect it's actually because of the 2-year gap in the construction of this phase 2. So we'll take a 15-year line, 15-year basis for the purposes of this calculation. It doesn't change much, but we think the 15 years is the most accurate because there's government information, I think, from the Hansard, which suggests that it was 15 years, with the first 2 years was basically the grace period. So we'll use that 2 years 15 years for the purposes of this calculation. In our next slide, you'll see now what's the future value of that investment. Remember, we've calculated that the total investment for the first two phases was $5.1 billion US. And as my colleagues have stated, we need to make an assumption about the applicable interest rates to be able to tell what the future value will be. Now, the number we work with is 10%, and the reason we work with 10% is because that was the opportunity cost. Now, by government of Kenya investing $5.1 billion in one project, it could not use that same $5.1 billion in another project. But the safest investment in Kenya at that time, which was government treasury bonds, was yielding about 10% per year. Remember, the base year is 2017. So what that means is if that $5.1 billion was invested or placed in a treasury bond for that same amount, its value would increase by the same equivalent of about 10 per year for the rest of the investment period, or at least for most of the investment period. So that represents the opportunity cost, which is basically the cost of comparison. So the baseline in our case is that 5.1 billion shillings owing on account of a 10% return. But what we try to be fair here is to give specific interest rates to see what those interest rates would yield. And the reason we bring in at 5 is depending on who you speak to. Again, some stuff about the standard gauge rate are not very clear. Nevertheless, we take the most conservative leaning so that we come as close as possible to judging the investment value. Now, so we've taken an interest rate of about 5%. We've assumed an 8% and then a 10% at the top to calculate the future value for every respective interest rate. And then what you see in the third column is the growth multiple, which tells you what that interest rate applies for a 15-year investment term. And so if you apply 5% over 15 years, the growth multiple is that the amount of money that will be collected will be about 2.1 times what the initial investment is, which you can see as 5.1 yielding 10.6 billion for that period. At an 8% interest rate, to be 3.17%. And of course, at a 10% interest rate, it comes to 4.1 times, nearly 4.22 times. So that's what the figures we're working with. So for investing Kenya people's taxes at 5.1 billion in 2017 for a 15-year tenure, the government of Kenya would be expected, using reasonable economic calculation, to yield an investment of 21.3 billion, right, over that period, the same 10-year period, especially because that instrument was available. So it's not unimaginable. Now, the reason we indulge ourselves by placing 5 and 8% is because depending on who you ask, some people say that the Chinese return was given as a concession. So the part of that loan is a concession, meaning then that the interest rate would come down. Perhaps so. Or other people say that the real agreement stated that it was 6 plus LIBOR. LIBOR was at about 2%. 6% was the baseline. So if you add at 2%, it comes to about 8%, which would still be possible. Now, the distinction we need to make here is that there's a difference between whether government would pay the loan and whether the loan itself or the investment itself is worth it. Now, government of Kenya tends not to repudiate its loans, so this will be paid from your taxes and mine. So by making this analysis, regardless of what our outcomes are, it is not judgment about whether the loan should be paid or not. I think that's political and legal decision-making based on contracts. What we are saying is whether a reasonable person sitting in 2017 should spend $5.1 billion US dollars of Kenyan taxpayers' money and then push it into an investment such as the SGR, given what alternatives still exist. So we've now stated what the growth multiple is, what the future value is, but the the applicable one for us is 10. The others are for the purposes of comparison here. So let's go to the next slide. In the next slide, we see, yes. Now, by discussing net present value, what we're trying to say is that, look, if you had $5.1 billion and you've invested, for an interest rate of 5%, 8%, and 10%, what is the equivalent annual payment that you need to make for the tenure of 15 years in order to extinguish that loan? And by that, bring the net present value to zero to make sure that the investment just completely pays for itself, right? Because that's what brings it now. If the net present value is zero, it means that you've broken even. If it's more than zero, it means that the investment has actually yielded a positive return. If it's negative, it means that all the cash flows from that investment, even if it was brought back, would not be enough to justify making that payments. So it calls to the prudence of the decision making in the first place. So at 5% interest rate, the annual payment that would be required in US dollars would have to be 486 million, right? For the SGR to generate revenues of at least 486 million shillings in revenues, which would be used to assess, or rather, to extinguish the loan requirement. Again, we say this is revenues that should come from the operations of the SGR. That's different from whether government pays that amount out, right? Because government could still pay that amount out regardless of how much the SGR yields. It means it needs to yield 486 million per year for the entire lifetime of the project, or rather in the lifetime of the loan to justify this. At 8%, you need 596 million, and at 10%, 671 million. So the total repayments come down to those numbers that you see, and of course, the interest cost is the cost that is earned on the interest itself over that period of time. So what this tells us is that using our yield of 10% every year, which is our opportunity cost based on what was the yield on government paper in 2017, the SGR ought to generate revenues of $671 million outside operations or whatever, just for the purposes of paying the loan. And we know that comes down to about $50 million per month, right? Prorated about $51 million, $52 million per month, all the way down to, actually close to $55 million per month, all the way down for the entire life of the project. Is that what happened? In our next slide, 15, we see what the reality of the SGR's revenues were. Remember, this is a 15 years. Now, SGR started in 2017 or launched in 2017 in June 1st, I remember. So obviously for the 2017 numbers, that's a half year number. So we need to be fair about that. The yield or revenue sources are, whether it's on the passenger side or the cargo side, that's important as well. And as you can see, in 2017, the total revenue was $5 million from passengers and another 18 million from cargo. These are dollars. And we've converted these dollars based on numbers from the Kenya Railways Corporation. They have the annual reports, and then we converted using CBK numbers. And of course, the cargo numbers, in terms of tonnage, which you'll see a little later, comes from the National Bureau of Statistics. So we're using government data here. So you see that the yield passenger revenue rose from about 5 million to 27 million in 2023. Those are provisional numbers according to the National Bureau of Statistics, the economic survey for last year. And the cargo numbers rose quite substantially from 18 million per year, or for the half year, all to about 160 million. With some shock that we saw during the COVID year of 2020. 2020, yes. And also, as you can see, both passenger side revenues have been growing and the cargo have been growing. And the total revenue is obviously up here. What you'll notice from this is that this is definitely, as was intended, a cargo trend. 75%, sometimes as much as 80% of the revenues come from the cargo side. So telling you the business case, which was based on cargo movements, still stands, at least for the, to the extent that we can see revenues coming in from the cargo, and the tonnage, the haulage. Now, so if these are the numbers, what does it tell us? And so as you can see, if you expect 671 million every year to be able to break even, you can see what happens is that in the first year, it was at 5% of that requirement. Last year in 2023, the year for which you have the most complete numbers, it was at close to 20% of the requirement in terms of the total revenues. Remember, merely to pay the loan component, forget about the operations and other costs that might be required. The SGR is very, very much behind. Remember, it is almost at the halfway stage of the 15-year blowout, right? The period that's required. So the SGR is very, very much behind. And remember, a loan requires that if you do not pay the amount in the first year or whatever amount is required, then of course it becomes part of the principal and the interest for the subsequent years. So as we are saying here, both the passenger and cargo sides have risen dramatically, but that's insufficient to actually meet the minimum requirement to pay at the 10% range, not even at the 5% range, which would have required close to about $400 million. So let's go now to in our next slide. So we're asking ourselves, okay, what's our revenue per ton? Remember, as I said, 80% of our SGR's revenues seem to come, 75 to 80% of our SGR's revenue on a year-by-year basis tend to come from tonnage. So we ask ourselves how much revenue is generated from per ton, as we try to ask how can these numbers, the numbers be chased. So you look at it, it comes from about revenue per ton of about 15 million per ton, which is basically how much tons were hauled divided by the revenue that came from that point, and you find out what the revenue per ton. And this has improved quite substantially from about 15 to 26, which is close to about 90% improvement in the cost, right? Revenue per ton. And that's not just because the tariff has been raised, though the tariff was raised, but I think the other thing that was happened is that the SGR started to carry higher value goods, some component of higher value goods, especially fuel, which has the highest cost per revenue. I mean, the highest price per tonnage, coming to about 50. And on the whole, you see it as about 26, and it's about at that 26 level, given that most of what the SGR carries are bulky goods, which tend to be very bulky, suitable for rail, but they tend to have low value. So most of it used to be Kenya's soda ash, for instance, is 30% of the carriage. The other is basically when Kenya imports maize, which are low value goods in comparative terms. And so fuel and electronics, which have the highest cost globally for tonnage, which comes to close to 50, are not carried in sufficient volumes in Kenya to raise this revenue. I mean, to raise the revenue for the SGR. And of course, remember what you're trying to chase is to bring it towards a positive net present value point. So that's it. It's about 26. So we ask ourselves, what might the SGR need to do to actually catch up? As we can see already, it's in negative territory, so it's a negative present value. So as it is purely white elephant territory. But some things might change because many people say, well, you for an infrastructure project, you need time to be able to catch up. So let's see what happens. In slide 17, we have a thought experiment. So we are saying that given the facts as we did in the slide 15, the revenues in 2023 was only 180. And yet what is required is 670, so it's almost $500 million below what is required to justify that price, even to pay the component of the loan, which we think is at 8%, which would require about 400 million. It's at 1/3 what is required. Something here could have to change. And as we've shown, two things could change. One, the tonnage. Remember, the capacity of the SGR is 22.5 million tons per year. And as you saw, it carries 6.1 million tons in the last year in 2023. So it's operating at 1/4 of its capacity. The argument then is that if you stretch it all the way to be able to provide services to the rest of East Africa, you might be able to cover that capacity. And maybe there's logic in that. But when we ask ourselves, what are some of the things that may need to change? And as you can see from this, we go into a thought experiment in which you're asking, so if you change the haulage cost from $26 to 30 or to 50, how does that work? We simulate what amount of tonnage will be required to be able to meet the 672 million, which is required to pay the revenues. Which is required to pay. And we go with each of the revenue amounts, 300 million, 486, 596, which is at 8%, and obviously 10%, 671. So if you look at it, 300 million is a number that we simply place here because 300 million was what was required to be paid every year to service the loan for phase 1 alone. Remember, Nairobi, Mombasa. Mombasa to Nairobi. But that's not essential anymore because you have a second phase all the way to Naivasha. But I put it here for the purpose of thought. And you see that if the haulage costs was brought to 30%, to $30, which means you're going to have to raise it by about 15%, sorry, about 14.9, 15%. Then to pay for the 300 million that was required for the Nairobi, Mombasa to Nairobi part would require tonnage of 10 million, which means you'd have to raise it from 6 to 10, which is about a 60%, 67% increase in the tonnage. If, however, the haulage cost went to $50, say you're mostly bringing up fuels and all that, and I know why there's a caveat for that. The caveat is Kenya has an efficient pipeline which also carries fuel. They are all manner of trucks, so this service has substantial competition. So the degree to which you can raise prices is also limited by the fact that you might actually, the service might actually have to go down to the others. I mean, to the alternatives. Alternatives exist. It would actually, so to make sure that the haulage cost pays for 300 million cutoff would mean that, yes, you keep it at the numbers as it is, but basically raise the haulage cost to about 50 million. But then you're only paying the Mombasa to Nairobi component of the loan. And even then, at an assumption of 4% per year. If you go down to 5%, it's 16.2 to 8%, you'd have to carry 19.86. And if the haulage cost was raised by 15%, right, and leaving everything else except for tonnage growth, to pay for the 671 million which is required to service that loan and to make it break even, you'd actually have to exhaust the capacity of the SGR itself. In other words, you'd have to make sure that the SGR runs full speed, 24 hours, and every journey is at full speed at 22.3 million percent. I mean, 22.3 million tons carried per year. That is huge work. If, however, the costs were raised from 25, the haulage cost was raised from 26 to 50, which is 96% raising of the haulage cost. The 300 million cutoff, of course, it would just be at the pace where it is today in order to pay the first phase, but it wouldn't pay for the second phase, meaning either government would have to top it up or wait to actually recoup that from the future. At the 486, 5% margin, you'd have to raise it from 6 million to 9.72 million, which is basically close to 60% higher tonnage. At the 596, 8% return, which is where most infrastructure tends to be, you'd have to still raise it by close to about 90%, raising the tonnage and raising the haulage cost by 96% and raising the tonnage by 96%. Highly unlikely, if you understand some little economics, that if you raise the price of something, you get less of it, especially because there's competition, right? So if you raise the price of the haulage, you might get less of it because people might decide. If you're talking about diesel fuel, then people might, I mean, companies or those who are clients might decide to use the pipeline or might decide to use other alternatives, including trucks, which could do the same job. At 61, raising the price at 671 million, which is where we are today, the opportunity cost per year, you'd have to raise and raising the price by 50 million, I mean, to $50 per ton. It means you'd have to exhaust slightly close to 58% of the SGR's limit. So the reason we show this is to show you how ambitious this program was and how much more work is required in terms of its own internal deficiencies, but also the growth in this Kenyan economy and the outward economies, Uganda, perhaps Rwanda, the DRC, in terms of their demand, to just be able to pay for the first two phases alone. So if you add the second two phases, we see this as extremely tall order. And in our view, for that reason, unless something changes dramatically, are there countries that have $50 haulage? Yes, they do. But they tend to be countries that are properly middle income, actually high income. Saudi Arabia has $70, and so does the UAE have $70, but that's mostly petrochemicals and fuel, very highly refined fuel. And anyway, they can afford it across the rails. For countries at Kenya's income levels, it's unprecedented to have an average of $50 for haulage per ton and to be able to maintain it on an SGR. Based on that, my judgment is this is a project perhaps had some good rationale, but it was unduly large and the costs were high and the interest and debt service payments that were negotiated were not the fairest, or at least not as prudently done as is possible. For that reason, based on existing numbers today, we didn't see the SGR as being able to actually turn over to positive net present value. For that reason, I call it a white elephant. Thank you.
Thank you. I'll be taking you through the Nairobi Expressway, and what you see here is just it's just a picture of the Nairobi Expressway, which runs from the JKIA, passes through CBD all the way to Westlands. Yeah, and these are just a few facts about the Nairobi Expressway. It's 27.1 kilometers, the total length, all the way from the Jomo Kenyatta International Airport to Westlands. And the initial estimate when the project was starting, what was intended was an expenditure of 65 billion on the whole project, but they ended up spending 88 billion. It was built through a public-private partnership with a Chinese company. Yes, and the construction started in 2017 and it ended in 2022. And the expressway was officially opened in June 2022. And the repayment period for the public debt that was used in the construction of the Nairobi Expressway is meant to be repaid in 27 years. And for the purpose of calculations for the net present value for this project, we'll assume an interest rate of 10%, which was the safest rate according to the government bonds that were issued that year. And the average toll that you're going to use to calculate our future value, we'll assume the lowest toll being 170 shillings and the highest being 500 shillings. And according to the Kenya National Highway Authority, the vehicles per day that used the Nairobi Expressway in 2022 were 11,000 cars per day, and it increased to an average of 45,000 per day in 2023. So the next slide, we're just looking at the net present value. And if we remember from the calculations that we've had for the two case studies, the future value equals to the present value multiplied by 1 plus the interest to the power n, that is the period, or rather the number of years. So our present value, what you're working with, is 88 billion. The interest rate that we are assuming is the 10% interest rate, and we have different periods. So we have 27 years, which is the repayment period. Then we added 5 years to just do different assumptions, or rather scenarios, to see how the repayment period will be if we maybe increase the number of years. What amounts will be supposed to be paid, either per year, per month, per week, or per day. So we had 27 years, 32 years, and 42 years. So for the future values, for 27 years, it's 1.15 trillion. That is the future value for 27 years. It's supposed to realize that amount after 27 years. In case the 88 billion was maybe invested in a government bond or whichever bond, it will realize 1.153 trillion in those 27 years at a 10% interest. In 32 years, it will realize 1.86 trillion. And in 42 years, it will realize 4.82 trillion. That is in 42 years. And these amounts were calculated per year. So we'll just look at the 27 years, which is the intended repayment period for this particular debt that was used to construct the Nairobi Expressway. So for 27 years, in case we're supposed to realize that's the real economic cost for the construction of the Nairobi Expressway. In case you're supposed to realize 1.15 trillion, a total of 42.73 billion is supposed to be raised on the use of the expressway. That's what they're supposed to get at the end of every year. Then per month, that is 3.56 billion. Then per week is 0.819 billion. And per day is 0.117 billion. And the same applies to the 32-year period scenario and the 42-year period scenario. So in this slide, we are going to look at what's really happening. Okay, that was just the future value that's supposed to be realize in case the amount was invested somewhere else instead of constructing the Nairobi Expressway. So here we have the reality of what they're collecting currently and matching it against what they're supposed to collect in case they invested it somewhere else. Yeah, the real economic costs. So to break even per year, we're looking at it across different periods, per year, per day, per week, and per month. And in this slide, we have how to break even per year. So we're assuming on the demand side is the number of cars, and on the supply side is the price that the government will be charging, the average toll fees. So on the supply side, we had 4 assumptions. We had, remember the average toll fees lie between 170 shillings. That's the lowest, and 500 shillings being the highest. But we added an extra column in terms of assumption in case the government decided to increase the toll fees. So with the assumption of 500 shillings being the highest, then the second column, we have the assumption of 170 shillings being the lowest. Then we had the median being 335 shillings in case they charge 335 shillings. And assumption 4, in case they decided to raise it to 1,000 shillings, will they be able to realize the paid amount that they're supposed to collect per year, per day, per week, or per month? So with 11,000 cars in 2022, they managed to raise, with the highest being 500 shillings, they only raised 2.01 billion. That is before the operating costs were deducted. And this matched up against the 42.73 billion that we've seen from the previous slide. Whatever they are supposed to realize, there's a shortfall of 40 billion in 2022. Then in 2023, with an average of 45,000 cars per day, that was 8.21 billion was what was collected. And this amounts to a shortfall of 34 billion in total that was realized in 2023. And we tried to look at this in terms of different scenarios in case they decided to maybe more cars decided to use the expressway to save on time. At what point will they break even? At what point will they realize the 42 billion revenue in a year? So it's only at scenario 3, whereby if they charge the highest amount that is currently being charged at 500 shillings, and the number of cars increased to 270,000 cars, they'll get 49.28 billion. Then if you look at assumption 4, if they decided to charge a maximum toll fees of 1,000 shillings, and with the scenario of 90,000 cars, they'll get a revenue of 32.85 billion, which is 10 billion less than what they expected to realize. It's only at scenario 2, and the 1,000 shillings assumption on the toll charges of 180,000 cars. That's where they realize the revenues of 65.7 billion, which will break even and also be a profit on their end. So currently, as it is, in year 1 and year 2, there's a shortfall. In year 1, there's a shortfall of 40 billion. And in year 2, there was a shortfall of 34 billion. So I hope you're following. So per day, if you remember from the previous slide, they're supposed to raise 0.017 billion per day to break even. But it's only when maybe the number of cars, the demand for the expressway and the number of cars increased to 270,000 cars per day, that's when they'll be able to meet the 0.117 billion per day. And if the toll fees is increased to 1,000 shillings, that is 180,000 cars, and that's when they'll be able to realize the breaking even for their revenues as well as whatever they're supposed to raise to repay the debts. And per week, it also applies the same thing. Per week, they're supposed to raise 0.819 billion. It's only at scenario 3 with an increase in demand to 270,000 cars. That's when they'll realize 0.9545 billion. And as assumption 4, with an increase in the toll fees to 1.26 billion. And also per month, it's the same thing. It's only when the number of cars increase, and also at assumption 4 with 180,000. So in this case, we ask ourselves, okay, if one factor remains constant, that's the length of the road, that is 27.1 kilometers. And if we increase the number of cars, will that road be able to sustain maybe 270,000 cars at maybe the same speed? Maybe it will cause maybe traffic or whatever. So looking at the length of the road, and also the maximum toll fees, and also the alternatives that exist, because if say they increase the toll fees to 1,000, but people will try to use different alternatives. They'll try to use the alternative road, which is just below the expressway. So yeah, consumers will respond to different price changes, and perhaps it will take so long for them to realize the amount that they're supposed to raise per year, per day, per month, or per week. And given this calculation, I'll say I'll make the call that the expressway is a white elephant. So what you have here is the life cycle of a white elephant, and it moves from a political promise whereby different politicians promise, or in whatever they'll deliver through a manifesto, and some of them go ahead and implement it once they're voted into office for different reasons. So it goes from a political promise, then they list consensus whereby different players are involved. Then there's the debt-funded construction. We've seen the SGR, the Isiolo Airport, and also the Nairobi Expressway. All of them have been funded through debt, either through private-public partnership or just the government doing the construction through debts. Then there's underutilization, which occurs maybe from lack of maybe a market analysis being done before, or conducting the net present value, the future value of the project, to realize whether it will be a negative or a positive net present value. And then we have future bailouts, whereby most of these infrastructure projects realize losses, and the government has to step in to bail them out. And there's also the call for subsidizing them. Yes. So that's the whole life cycle of our white elephants. Then what you have here is the comparative analysis, which shows different projects just from the conclusions that we've given from our findings for the 3 case studies that we've conducted, that is Isiolo Airport, the Standard Gauge Railway, and the Nairobi Expressway. and they all have a negative present value, and the opportunity cost for for the funds that are used in constructing these infrastructure projects will either be employing more nurses or doctors, which are needed in different hospitals, either building more classrooms so that kids will not be learning under trees. If we quantify maybe the amount that's used to construct maybe one classroom, maybe the amount that's been used in constructing Isiolo International Airport could have been used in maybe constructing maybe 5,000 classes. And yeah, of course, we know education has a positive externalities. And then we have the Nairobi Expressway. If maybe the Nairobi Expressway was not done and it will realize negative net present value, the money could have been used in maybe purchasing of vaccines in case there's a shortage. Then the political drivers that led to construction of these infrastructure projects with negative present value. For instance, the Isiolo Airport, it was done with the objective of leaving behind a legacy by the regime that was in power at that time. Then for the SGR, it was technological transport prestige. They were trying to sort of upgrade the railway network in Kenya by having a fast train, which is not so fast. Yeah, but the political driver was for technological transport prestige and also a legacy issue. Then for the Nairobi Expressway, if you remember, the Nairobi Expressway budget allocation was done with the objective of having a double-digit GDP growth rates being realized, because the public-private partnership will give quick returns in terms of profits. But we've seen both in the first year and the second year, if we add the shortfalls, and also the length of the road being constant all years, I don't know at what point they'll be able to realize the profits or even break even. So yeah, according to that, we conclude that all these projects are negative net present value projects. So what lessons do you have from our findings? Yes, why does Kenya repeatedly continue having white elephants? We have incentives that show political legacy is better than economic sense, because every politician, or rather everyone who's vying to be for presidency, or even at the county level, everyone who's vying for maybe a governor position, they're promising to build something which most of the time has negative present value, just to leave a legacy instead of an economic sense, or maybe to be re-elected. And then there's also the weak ex-ante evaluation, whereby market analysis is not, most of the time is not conducted properly to look at whether this project will bring in a positive net present value, or rather it's value for money. Is there value for money in a project before starting to implement a project? That's something most of the times is not done. Either it's rewarding their friends and cousins to win tenders in construction of maybe the SGR and other projects. There's also weak accountability. Following up on construction of projects that are realizing next present value. There's weak accountability for the people who are supposed to keep the government accountable. And also, there's also the populist symbolism. If you remember the hype around the SGR and also the hype on the expressway, it was called the superhighway. Yes, there's the hype around it, and people overlook the net present value when they're hyping something. And also the opportunity cost is borne by the whole social group. So the kids who would have gotten a classroom, the hospital, which would have gotten maybe doctors, nurses, or maybe the vaccines that would have been available. It's affecting, literally everyone. Then these are just some recommendations that you're offering. There should be independent and comprehensive net present value audits before the start of an infrastructure project construction, and also to just make them public so that people know, the public knows whatever it's getting itself into in terms of, because we at some point you'll have to pay taxes to refund the debts, and also the transparent public-private partnership renegotiation clauses. Yes, in case an infrastructure project, or rather White Elephant, is making losses or whatever, the renegotiation clauses for the public-private partnership needs to be made public, so that's for information access to the public, and also opportunity cost disclosure in parliamentary reports. It's efficient if people know, maybe if at all, maybe this SGR was not constructed, how will that money have been used? Or maybe if the expressway was not constructed, how will that money have been used? So that people can be able to weigh between the two and decide if something has negative present value, maybe not invest in the particular projects. That's the end of my presentation. Thank you.
Yeah, thanks a lot to the three speakers, Vivian Ochola, Kwame Owino, and Maureen, for that insightful presentation. I think you've done a good job, even in terms of just concluding the entire presentation. I mean, just to mention, obviously, what the three speakers have showed. First, obviously, what is often cited or reported, particularly in the media, is on white elephants are usually just other, characteristics, like the fact that of course, these projects tend to be politically attractive. There would be mention of the huge costs, but identification of whether they are white elephants or not is rarely done. So of course, this market analysis is important, and it basically shows that, at least from what they mentioned in terms of definition, white elephant projects are those projects that have a negative net present value, mathematically or from a market analysis perspective. And so each of the three speakers, based on each of the three case studies, have showed us that these three projects, Isiolo Airport, Standard Gauge Railway, and Expressway, actually have negative net present value. So of course, they computed the future value, compared that with the actual cost, in terms of what is being generated. So obviously, for the revenues from the landing cost for airlines at Isiolo, and of course the revenues from both the haulage and people's transport for SGR, as well as the for the expressway is obviously revenue from the usage of from the toll by user in terms of usage of the expressway, and all of them actually they had negative net present value. So that opportunity cost computation of that is critical. And of course, they've also shown, Maureen concluded by just showing that if this money was not invested in each of these projects, where it would where those resources would be invested, obviously in areas that are critical in terms of public service delivery. Okay, so with that reality, I would now like to open this up for any question and or any comment from our participants. I already see there are a few questions that have been posted, but I would like to give an opportunity maybe to 2 questions verbally. If any of our participants would like to ask a question verbally, please feel free to, you can actually unmute yourself or raise your hand, and I will point to you to ask your question, and obviously you can direct it to any of the 3 presenters. So 2 questions. Let's take the SGR as an example, but probably applies to the other 2 case studies. So number 1, we've used 15 years since that's the repayment period. Shouldn't we use the expected life of the line instead? So that's the first question. Then number 2, rather than just direct revenues, shouldn't we also try and take into account indirect revenues? Things like what government mandarins call opening up the interior. So Kwame, I hope you've noted those 2 questions. And then we have a question from Jane Guitar. So what Jane is asking is whether we have the cost scope of the proposed Rironi Malaba Road expansion project to be funded from the pensions fund. So we have those 2. I'd like to open it up to our participants, but maybe as I guess as they're warming up, Kwame, would you like to respond to? Please respond to KW's question.
Yeah, should I go? Okay, thanks a lot, KW. Yeah, those are interesting questions. I mean, that's the first question particularly is very important. Yes, so you asked, so we've used, for the purposes of calculating the net present value, we've used 15 years for a railway line. And you're saying that that's the repayment period for the loan, and that's perfectly correct. Why shouldn't we consider the life cycle? And might that change the analysis? Maybe that's the question you had, because I'm adding that. And the point is, you're right, that railways generally have a lifespan and a life cycle beyond 15. So to actually top up everything and make that, use that for the purposes of discussion is might hide the fact that, look, it's possible that towards the tail end of its life, or after the loan is paid, the railway line the railway service actually gets much better. So the first thing we've done is that in Kenya's case, we've looked at the SGR based on the terms and based on the opportunity cost. Now, those opportunity costs are not going to disappear because of time. In fact, if you take a longer time, after the first 15 years, and you've paid the loan, then the rest of the time it's supposed to run for itself. So what that means is that if, as we've shown, that the SGR is struggling and we are halfway into the loan tenure, actually into the second half of the loan tenure, it means that the last 2 years, the last half would have to be much, much higher rates. And some of those, as we can tell, to run it at 30%, at $30, to maintain it at $30 would actually require that you go over capacity to be able to pay for the first 2 phases at 672. So all that still brings it back to the fact that it is not, it's unlikely. So that's the first question. The second thing that I'd like to answer is, we've made very conservative views. One of the conservative views that we've made is we have not even taken account of the fact that the SGR in Kenya was constructed. We didn't use all the costs. The SGR Kenya was not only constructed, but the land and the easements that were made, and easements is the legal argument for people who had to be paid and bought off for the railway line to be constructed across their land. The cost of that have not actually been added to the SGR analysis itself. We've just added the construction cost and the cost for the loan, which would make these numbers even much, much harder. So by hiding the land costs on the other side of the SGR, it becomes really, really troublesome to actually put it. But we put the numbers that are available and we try to put it here. So we know that yes, it goes over 50 years. But if you look at it, a railway line is usually supposed to deliver revenues, or rather returns, is usually between 8 to 15%. Now, as you can tell, the SGR is actually below 3.5% at this moment, and it's halfway into the cycle for the payment of the loan. So for that to happen means that in the later years, it has to go to closer to not just 15%, actually about 20% for that to be done. We don't think that's possible, especially because there's a limit to how much cargo it can pay. I mean, it can carry. And if that has to be bumped up with an increase in the cost, as we said, if costs move both in terms of the cargo limit and the cost rises, it's unlikely that there'll be no leakage into other sectors. As you know, one of the things that happened when it started was that there's a presidential decree that at least certain amounts of cargo had to be moved on to through the SGR, and gave it quite some revenues, because then it took cargo away from the railway, I mean, from the competing trucks and others, and people were forced to have to take their cargo here. So unless there's growth on the other side, we see that as unlikely. But even if to pay for that 672 million and to maintain that, because there'll be payback loans, it's unlikely that it will be, unless what you're saying is that the subsidy comes from government, or government writes off by paying the loan, nevertheless, but writes off the idea that you can actually regain that, which means the public will actually have to pay a tax to pay that, which doesn't change its net present value terms, even if it might keep the railway running by actually wiping out its debt obligations. So yes, that's the decision we made. But you're right, the life cycle of a railway line is up. But you know that in the first life cycle, as it becomes later, administration costs rise. And obviously you need to replace, and in some places, something like $10,000 per kilometer of truck per year in terms of truck maintenance. That's a lot. Remember, it's already 500 now. So $10,000 by 500 comes down to close to, is it 5 million or thereabouts, which would have to be added just to maintain the truck and keep it up. One other thing about the SGR that makes us clear that it's a serious one is, in addition to the construction cost loan, the SGR is hidden costs, which is basically the maintenance cost. And the maintenance cost, which was being run for the first, I think it was for the first 5 or 6 years, was an additional $10 million given, which was equivalent to 1 billion shillings given to the consortium that was actually running it on behalf of government. No, not the consortium, rather, the company consultants that were running it on behalf of government, of about $10 million per month. So it means that on our 672, you'd have to add another 120. Bringing it down to 800 million. So if you take the real costs for running the SGR on $800 million, I mean, we're just talking here of $800 million per year. We're just talking here of numbers that actually are unreachable, but also its capacity. And that tells us something about the way this was negotiated. The loan was too expensive and the construction costs were too high. Whoever is responsible for that is a different decision altogether. Then you mentioned the question about land. The indirect costs are usually very interesting for white elephants, because that's what people tend to argue, that no, we do not intend to run the railway line, but it creates other things, like it opened up the Mara. I'm not too sure that it did. It opened up these other people, and also it made Kenyans feel more patriotic, and suddenly we're all putting on t-shirts with Kenya here, and I'm proud of to be. That's not usually my thing, but if you want to buy patriotism, or you want to buy opening up the country, the other ways of opening up the country, right? Just spend that money to open up the country instead of trying to do it indirectly. So for instance, if you think that you need to create an administration center in, say, a place called Wote, or you need to create one in Mudanyi, or you need to create one in Voi, just go up there and construct something within Voi itself without necessarily interfering by constructing a railway line whose effects you hope to be indirect. So it's tough like that. Now, in other parts of the world, what they do, whenever they do that, it's true that constructing a railway line sometimes raises the value of the land, adjoining pieces of land. And one of the things that then governments do is to tax that land. Since we don't have land taxes in Kenya, it is not possible to appropriate through other revenues the costs or the benefits that the SGR has generated. And so what that means is that the SGR was a public investment, but it has generated private value to people who are not paying for that private value. And that in itself is a political choice that was made. And all together, when you bring it together, it still brings us back to this ball. This is negative present values, and it's therefore white elephant. But thanks for those questions. Thank you.
Yeah, so thanks, Kwame. Of course, KW has acknowledged your response, and I see also Maureen has posted some a link to some material that may be of help to Jen, who's looking for, the cost scope for the Rironi lab, of course, which is outside our scope here. But yeah, so those are, so maybe Jen, you can later refer to materials in that link. So yes, we have this second round and final round of Q&A, and I think I saw a hand up from Martin Musau. Martin, are you there? I don't see any other question in the chat box.
Yes, I am. Can you hear me?
Yes, please go ahead and just introduce yourself and mention and pose your question, and then mention
Yes, I'm
obviously.
Martin.
Go ahead.
Thank you, John. Yes, I'm Martin Musau, and I had a question, although it has been largely addressed by Kwame, because I was looking at how you have addressed the NPV as a common denominator for checking weight elephant and whether projects are profitable in future or not. Probably. Do we have another formula whereby we can also look at other benefits which accrue? For example, when we talk about expressway, which has to reduce the time taken from either JKA to go to Westlands, do we have a broader formula which we can incorporate those other indirect benefits, which are as well going to contribute to the economic development of the country, other than strictly following the revenue formula? Because I was looking at the time wasted because we have shortened it. So you find that the time which we are taking to move, either goods or people, we have saved a lot of economic time, and that is a benefit which, if we quantify, we may find that the resultant economic development is really, really high. So do we have that as well, and such that we capture it in our calculation to help us to look at it in a more broader way? Thank you. That was my question.
Yeah, thanks, Musau. I believe our three speakers have noted that. So basically, whether there's a formula that captures other monetary benefits from such like projects. Do we have? So yes, we've noted that. So we still have an opportunity for maybe another 2 or 3 questions or comments from our participants. Yeah, from the chat box, I don't see any additional questions. Okay, I see one now. So this is from Jairus, who is our colleague here at the Institute of Economic Affairs. And this question is, what are the chances that completion of phases 3 and 4 of the SGR might turn around fortunes of the project? And based on your assessment, what is the best way forward? Okay, Kwame, that's a question directed to you.
Okay, so let's go with yes. Should I?
No, just a minute, Kwame. Okay, I don't see any other question from our participants. So what I'll do, maybe Kwame, you come last. So I would like to request Maureen to, if you have any response to Musau's question, please go ahead and also give us your final remarks. And then thereafter, Vivian, again, if you want to make any additional comments to any of the questions that has been posed, please do that, and then you can also give us your final remarks, and then Kwame will conclude for us. Thank you. So let's start with Maureen.
Okay, thanks. Okay, for Musau, that's a really nice question, and it's a good way of looking at it. Yes, looking at other benefits outside, yeah, the net present value, just the value for money. Yeah, of course, other benefits exist, but for purposes of this webinar, we're just focusing on the net present value to check whether it's a white elephant or not. But I believe maybe looking at other things like the cost benefit analysis might give you maybe the time saved. Yes, there's also the time saved. If you calculate that from maybe the profits that have been realized minus the operating costs, using also the time saved, you also get other benefits. But yeah, for the purposes of this webinar, we just stuck to the net present value. And thanks everyone for attending the webinar. Yes, thank you.
Okay, thanks, Maureen. Vivian?
Thank you. Now, just to add on the question that has been asked, yeah, there are other ways to calculate that includes the indirect benefits. But for these, net present value normally considers the direct benefits. So there are other ways, like one which Maureen has said on cost benefit analysis. There's also another way of calculating that includes the indirect benefits, and that is economic internal rate of return. Yet for this analysis, we are focusing on the net present value. Then for my concluding remarks, it is true that from the data and from the calculations, we have seen that these projects, they show, or they are a classic case of mismatch between infrastructure, investment, and economic return. And there's a need for value for money, audits before a future project is undertaken. And also, since we have seen that in the life cycle of a white elephant, it normally starts as the political promise. So maybe if there should be a rethink of infrastructure through a return-based lens and not a political lens, that will help. Yeah, thank you.
Okay, thanks, Vivian. Kwame, over to you.
Yeah, okay, thanks a lot. So two things. So Martin, yeah, I mean, just to come back, my colleagues are doing, look, the problem with what people are asking, that let's use a mechanism that gives us the answer we want, is then because it would make every project susceptible to using a methodology that people think will give us a positive return. So that's one. Now, external and negative, I mean, or rather, indirect returns become difficult to quantify, but they also become difficult to justify. Because if the indirect return is the development of a place, then one did not construct a standard gauge railway to develop that place. What you do is then you go and make those investments in those places directly. So that tends to be the political language that is used to try and justify the sustenance of a white elephant, because it's generating so-called positive returns that are indirect and are usually very difficult to attribute to one project. So that's the first. And what it's telling us is that the projects that we've looked at are different. One, not because government could pay the loans, but because government commits. So whoever has constructed them or whoever has funded it will receive their benefits regardless. And then it's the public that is left with the idea of paying, with the obligation to pay regardless of whether this investment was necessary. I mean, whether this investment would meet its costs. So they tend to be too large in terms of scale. Why they would be large in terms of scale is something that we wonder about. But it reminds you that when people are spending money for which a government or a political authority can actually forward the costs into the future, then they usually are not as mindful as they are. Thirdly, we can't use another methodology, because if you're saying that the standard gauge railway is an investment, it needs to meet investment decision criteria. And that is the one to which we have subjected it for. So my colleagues have stated that there's an alternative. I think they needed to be careful. What they mean is that when you do a net present value analysis for an investment, it will lead you to suggest what's the internal rate of return that is required on a year-by-year basis for it to sustain itself. And when it doesn't meet that, then it's telling you that this investment perhaps should not be achieved. Thirdly, when the government is spending 5.1 billion on two phases of the standard gauge railway, at that point, this was almost equivalent to 5% of Kenya's GDP, slightly less, about 3.5% of Kenya's GDP. We cannot say that let's spend the money and find out later what the indirect benefits will be. That's reckless decisions regarding public finance management. In fact, if you look at Article 201 of Kenya's Constitution, it requires that responsible shifting and balancing of costs between present and future generations should be burdens between present and future generations should be considered. So to construct a big white elephant and then say that look, it will generate indirect benefits to other generations or even to us and all that does not strike me as meeting the criteria that is very broadly stated in as the principles for public finance management. And that's why we say, I don't think the government should have a different view to choose the instrument that it wishes to use to invest in white elephants. I think internal rate of return and the net present value basis are considered good and solid methodology for determining whether an investment should be. Now, our view was not to go into a political function with people about all this. Our view is to say, look, if you use the registered and the acknowledged methods that are used for projects even bigger, other countries use the same projects and decide whether to scale down a project or not to scale it down or to choose one project against the other. This is the methodology that applies. So we wish to persuade you that you shouldn't get the impression that government should be allowed to fish around for whatever methodology or one, which one meets their view. But you can see political influences is more bound to lead to white elephants when the decision criteria does not involve a strict cost decision making and to think about what it would require for the returns to be made on the other side. GIRAs. So for instance, why indirect costs are also interesting is Martin Musau used the example of the time that has been saved by for driving from the airport, for instance. It might even be from Lolongo into Westlands, and that's an advantage. But let's remember one thing. For an economist and be right, the value of something is usually represented by how much money you're prepared to pay for it. So if somebody is paying, say, 500 shillings to be able to cut the journey from the airport to Westlands, right? That payment itself is a reflection of the savings that they're making because they're deciding whether it's worth paying 500 shillings or not. So we cannot say that because it's saved for 11,000 people, maybe 1 hour per person, therefore means that it should be an investment that should be taken and that its cost should actually be dumped on the other 52 million Kenyans. You need to think about it like that. Where do the gains lie and where do the benefits, where do the gains lie, which is the benefits, and where do the profits, the cost lie? And if you look at it on that basis, yes, it is saving a lot of time for some people, but that by itself does not justify constructing it at public cost, because otherwise then it would be constructed entirely at private costs, which is perhaps what should have happened with the expressway to begin with. I think its cost would have been much, much lower than what has been dumped on the public. So that people are prepared to pay 500 shillings to travel 20 kilometers in itself a reflection of the fact that they value their time sufficiently to be able to pay that. But then again, not everybody is doing that. And if that is what they value, then perhaps it is to the people whose benefit, who appropriate the benefit, who should actually pay the cost of its construction. But that's not what we have here. And that's why a net present value analysis still has to be conducted. GIRAs has stated what are the chances, what would happen, what's my advice on the SGR into. So that's, you're talking about phase 3 and phase 3B, right? Which is phase 3 is would be the track from, I think, about 160 kilometers track from Nairobi, from Naivasha, all the way to Nakuru. And then the subsequent, from Naivasha all the way to Kisumu. And then the final phase will be from Kisumu to Malaba in the border. And my view is that it depends on what costs it is constructed at. If it's constructed at the same cost and on the same terms as we've had with the first SGR, it is not going to pay for itself. It will be making a bad case worse by pushing good money after bad, right? Because it will be much, much bigger. The net present value would actually expand, and you can tell with the volumes that are required, unless the costs are raised, even with volumes coming from Uganda, Uganda, Rwanda, and into the DRC, it is unlikely that the sufficient volumes would come. Because remember, those other countries also have extensions and they also have alternatives from other parts. I know that some parts of the Eastern Africa, which is basically from the DRC and other areas, already come to pick cargo from Naivasha and other places, and that might be sparse. But the point is, the throughput of the capacity of the standard gauge railway is only 22 million. And it's telling us that to pay the 672 million and to raise the cost to $30, which would be still unprecedented, it's much higher, you would need to use the entire capacity just to pay the first two phases. And so if you extend it, which would raise the cost of all the others, I think that would be at the same cost. I think that would be definitely, you don't have to go into the math to just make this a white elephant. So what might government do? Now, because these are already sunk costs and the 15-year loan will have to be paid regardless, I think my suggestion would be we need to accept that it's a white elephant, which is difficult. That would be a political move. And government therefore needs to pick up the first part of the loans and pay it and pass over this infrastructure piece to a business who now have to run it strictly in business terms without further subsidies. So government will just take up, because it was government's fault, whatever drove that, whether it was political corruption or economic interests of certain people, should actually pick that part so that you release the burden from the entire SGR line and then let the rest of it operate entirely in commercial lines. And the construction that may come forth should be actually more competitive than what we've seen before. Outside that, I think it will continue to be a project in which, because of prestige and all political promises, will be throwing bad money, good money out of bad. And remember, every time government throws good money out of bad and invests in a white elephant, the entire society suffers because you're throwing away money and reducing the welfare of citizens who would gain much, much more based on what the net present value is or what that return would be on a safe instrument. Thank you.
Maybe Kwame, before your final remark, there's a final question that was sneaked in by Emmanuel, and I think you've responded to part of it on the what to do with such project, but what about what to do to stop such projects in the future?
Okay, my colleagues already mentioned that one of the things that we need to do is every time government comes up, especially if a project is large, prestige has no monetary value, but it has cost, right? By trying to build the biggest thing in East Africa, whether it's a stadium or whatever, we should insist that government principles, and perhaps Parliament could do the best, by insisting that every project that they allow to be funded should be based on reasonable calculations with net present value, which requires public participation as well. Because remember, the SGR actually had its own feasibility study. And the assumption for the feasibility study was that the 22 million volume of tonnage would be carried very easily within the first, I think, 10 years. We can tell that's not going to happen. And so that tends to load it. Because when somebody is going to construct it and they have not done the feasibility studies carefully or meticulously and with sufficient subjectivity, then they'll give the impression that every white elephant needs to be funded. And also we have what we have here. So yes, we should input as a principle of public investments of a certain type and above, or maybe any public investment, to be honest, should be subjected to a net present value analysis available for public participation and public commentary. Thanks.
Okay, so thanks a lot to the three speakers, Kwame Owino, Vivian, and Maureen. So please help me to appreciate them for that insightful presentation. I believe you've learned quite a bit, and obviously it was worthwhile your time. And again, we are grateful to our participants for joining us in this webinar. So as usual, we will post this presentation if it has not already been posted on our website. And as I mentioned during my introduction, There are other materials. I think we have a blog post as well as the presentation that was made in last year's webinar that you can interact with to maybe get some more insights around the question or the economics of white elephants. Just to mention, the Institute of Economic Affairs is a membership organization, and so if you'd like to join to be a member, please get in touch with our communications department, and we've also posted information on the website. So feel free to get in touch with them. The benefits have also been mentioned in on our website. Of course, just to mention, obviously, there are other webinars that have been lined up, I think in the course of this week and next week. So feel free to interact with our website and also visit our social media